Hello everyone and welcome to our YouTube channel. We are seeing a spectacular rally in small cap stocks and a lot of portfolios that our clients follow are giving exceptional returns. But the key question that everyone has right now and a lot of messages and questions that I get from investors is this rally going to continue or is it going to be short-lived? Is it the right time to invest in small cap stocks or are we going to see a correction right now? Should I invest in the market right now or should I wait a little bit and invest when the correction is here? So in this video, along with Siddharth and Alina, I am going to unravel all about what's happening in the market. We are going to dig deeper into small cap stocks, the valuations, what are the scenarios in which small cap stocks rally and when do they correct, and we'll try to provide you the answers about if there is going to be a correction in small cap stocks or is it the right time to invest. But before we begin, please do subscribe to our channel, hit the bell icon and make sure that you're following up on our content. Also, please drop in a message, please drop in your comments, please drop in your questions or even just say hi on this comment. We always love hearing from you.
Indeed, with a whopping 20.5% surge in the Nifty Small Cap Index over the past quarter, reaching a record high, we can't help but feel a mix of excitement but also a little bit of caution. The performance has definitely left investors and market watchers both exhilarated and cautious. So let's try to understand the factors that are contributing to this surge. The big question here is, what's causing the rally?
Great question indeed. But to understand more about the rally, let's dig deep into the numbers as they're coming in. Like you said, the small cap index has indeed rallied 20.5%, and the rally has been quite exceptional and extraordinary. If you look at the benchmark indices Nifty and the Nifty mid cap during the same period, you would see that the Nifty has only rallied 10.5% against a 20% rally in small caps, whereas mid caps have also rallied significantly at 19.5%. Why are these rallies happening? So there are a lot of different reasons. We're seeing a lot of FIIs coming in and buying into the equity market. That is happening because India's macroeconomic situation is extremely strong. Corporate earnings are expected to be really good. And the growth projections for India are at the top of the world. So a lot of amazing reasons fueling this rally. And we are seeing some remarkable momentum.
That's right, the rally in the small cap sector has been extraordinary, and the robust earnings growth is a significant factor in that. For FY24, an earnings growth of 12 to 14% is expected. In fact, the current earnings season for the June quarter has been particularly strong so far, suggesting a year-over-year growth rate of 25% for Nifty companies.
Now, to understand the direction of the market, I think it makes a lot of sense to look at valuations, right? And if you look at the current valuations of the Nifty, especially the forward-looking valuations means valuations as per forward earning projections instead of historical earning projections. So as per forward earning projections, we are seeing a P ratio of 20.2x, which is higher than its historical averages, which sort of hints at overvaluation in the large cap stocks and maybe a possibility of a correction. The prices are high and the earnings number seem to be not working for the large cap. So if you saw the earnings that came out of Infosys recently, there was a huge correction in Infosys after the earnings because they cut down their projections for the future. Similarly, Reliance, bogged down by the oil and gas numbers, gave a disappointing quarter. So if the earnings take a hit, your PE ratios will get inflated and you could see some correction happening, which is quite healthy and expected in this spectacular rally. Now, although the small cap sector has seen an amazing rally right now, historically small cap valuations have always been at a discount to large caps. However, right now the discount has been narrowed quite a bit. Small cap stocks, because they are small, can grow earnings at a much rapid pace. That's why they can command high valuations. If you look at the historical trend of valuations right now, you would see that the small caps are nowhere near their historic highs. Historic valuations of small caps can go crazy, which we have seen in 2014, 2018, and many times in history. We're nowhere near that high. We still see a scope for growth, but because we have seen this very, very sharp rally in small caps, there has been a little bit of concern over valuation and there has been a little bit of concern on a scope for a short-term correction in small caps as well.
Now let's look back at the history of small cap rallies and corrections, which can maybe provide us with some valuable insights. We've had the rally from 2003 to 2007, followed by a sharp correction in 2008. Another rally occurred between 2014 to 2017, followed by a correction in 2018, and the most recent rally that happened in 2020 to 2021. Let's dive into each of these to understand what has happened in the past.
The 2003 to 2007 bull run. The period from 2003 to 2007 shines as one of the longest and most exhilarating bull runs. The BSE Small Cap Index fell from approximately 1300 points at dawn of 2003 to an eye-watering 13,000 points by 2007. This spectacular rise, a nearly tenfold increase. Why did this happen? Because during this time, India was growing economically due to the increasing local demand, foreign investment, and a bunch of government reforms that attracted investors. The investor-friendly atmosphere played a critical role in firing up the stock market engine, with small cap stocks soaring high amidst this bull run. In simple terms, it was a golden period for small companies. The 2008 correction. Sadly, the good times took a hit in 2008 when the global financial crisis happened. The catastrophic collapse of Lehman Brothers sent shock waves through global stock markets, with India being no exception. The BSE Small Cap Index plunged dramatically from its peak of nearly 13,000 points in the late 2007 to 3,000 points by early 2009. Small cap stocks, notorious for their higher risk profile, bore the brunt of this, losing about 75% of their value. This is because the crisis made money scarce, foreign investment reduced, and our economy slowed down, leaving the Indian stock market and its small cap sector reeling from the blow.
Despite the crash in 2008, small cap companies in India showed their fighting spirit from 2014 to 2017. The BSE Small Cap Index went from about 5,000 to nearly 20,000 points by the close of 2017. That is a fourfold increase. Investors found renewed optimism in the election of a new government in 2014, which pledged economic reforms, vigorous infrastructure development, and at the same time, the overall environment, the low global interest rate environment that we were in, made it easy for foreign investors to put their money in India. All of this ultimately helped the rally. Unfortunately, the excitement waned in 2018 and small cap companies took another hit, marking a significant correction period. The BSE Small Cap Index dropped from nearly 20,000 points to around 13,000 points, registering a loss of about 35% of its value. One reason for this market correction was that people were worried that the market was overpriced. Also, the US Federal Reserve started to increase the interest rates, making it more difficult for money to flow into places and economies like India.
2020 to 2021 rally. Yet like a Bollywood hero, small companies in India showed that they could bounce back. From 2020 to 2021, despite the problems caused by the pandemic, the BSE Small Cap Index rallied from around 10,000 points to nearly 23,000 points. This rally was bound to happen given the spectacular market drop triggered by the pandemic, the unprecedented fiscal and monetary stimulus measures implemented by governments and central banks worldwide, including India, to cushion the economic blow of the pandemic resulted in excess liquidity. A lot of money was available in the market, boosting the morale of investors and driving the strong market rally. Last year, the market was quite turbulent with major corrections seen across sectors. This year, however, now we're seeing another rally. But why are they rallying now? Why are our markets going up now?
The rise in our stock market, especially for smaller cap companies, is due to a few things. Firstly, companies are earning more profit and that is expected to increase by 12 to 14% for the financial year of 2024, which is making investors very happy and that is helping the rally. Secondly, our economy is doing well. India is set to grow and do very well in the coming years. That means more people want to invest in India, whether it be domestic or foreign investors, and they want to invest in the Indian markets as they see the growth potential of the Indian markets. In fact, big investors around the world now see India as a better place to put their money than China, according to a US survey. Why is that? Because we've got a stable business and political environment, a young and growing population, good regulations, and a welcoming attitude towards these investors. Third, our central bank, the RBI, and the government have been helping the economy grow. They have done this through various things such as adjusting the monetary policy to make borrowing easier and putting in place measures to stimulate growth in the economy. But keep in mind, market growth is a tricky thing and there can be a lot of factors that can influence this. The things that I've mentioned are just some of the reasons why markets are rallying right now, and this is all well and good. But do you think the market could correct now?
The recent rally in the small cap stocks does raise this question that are we due for a correction and will we see a correction right now? So first of all, the market is seasonal and prices adjust after a period of increase. Like we discussed, the Nifty PE ratio, the forward-looking PE ratio is a little bit inflated, and earnings for some of the top stocks like Reliance and Infosys are not coming up to the mark. We could see some valuation concerns and maybe a short-term correction, which we indeed saw last Friday. The smaller company stocks, they are cheaper than large cap stocks, and the discount seems to be narrowing, but we still believe that small cap stocks indeed have a good way to go, even with some correction or the other. Along with valuations, there are other concerns in the market as well. So if you look at inflation in India, it actually indeed heated up last month instead of cooling down, right? So that is a concern, if that heats up further. Secondly, the global monetary policies, UK is still raising rates, US has said that it might raise rates. So, we are not out of the waters yet, and we could see these global concerns also cause reasons for correction. But what is to understand is that we do have a very favorable macroeconomic situation, and it is very, very hard to predict when a correction is going to happen. I could never tell you that you could see a correction next week, next month, or next quarter. It is very tough to time the market. But the best case scenario right now is that you could take a flavor of the rally that is happening by allocating to equities, allocating to small caps, but maintain a very healthy asset allocation as well as very good diversification. If you are focused on your goals and you maintain a healthy mix of assets as per your investment goals, you would be ready to handle any short-term and long-term corrections that might happen in the market. The market presents some amazing opportunities, and by maintaining a healthy diversification and a healthy asset allocation, you would be able to achieve your goals without having to time the market.
Another popular question that we've seen when we've done live sessions or are just speaking to various investors in the market is that should I wait for the market to fall before I make any investments, since everything is at such an all-time high right now? When it comes to investing, timing the market is nearly impossible, especially when you're investing on your own. Time in the market is always more important than timing the market. As individual investors, trying to time your entry or your exit points perfectly isn't worth it. While it's true that the markets are at an all-time high right now, this doesn't necessarily mean that a major correction is imminent. The markets could continue to rise further, and by you waiting for a drop, you might miss out on some of these potential gains that are there. However, it is also important to consider your own personal risk tolerance when you're coming to these conclusions and decisions. If investing in the market when it's at an all-time high makes you uncomfortable, then it might be wise for you to wait for a time at which point you will feel more confident. But remember, trying to time the market can often lead to a lot of missed opportunities. If you are following an SIP approach, the best advice that we can give you is that in any market condition, it is always optimal for you to continue running your SIPs. Research has shown time and again that rupee cost averaging via SIPs has performed reasonably well over longer durations of investments. In simple terms, continue investing a fixed amount of money at regular intervals regardless of the market conditions. This can help you mitigate the risk of investing a large amount of money in a single investment at the wrong time.
Taking a look at the momentum of the market and the small cap scale, we at Wright Research have also introduced a new portfolio called Alpha Prime that attempts to combine momentum investing while capitalizing on the small caps rally in the current market. As markets evolve and change, the allocation will shift. This is the high risk, high reward portfolio that comprises of only 10 stocks. So do the necessary diligence before investing. If you are interested in investing in Alpha Prime, use the code ALPHA25 to get 25% off. This is valid for a limited period of time only. That's all we have for you today, folks. Remember, the recent small cap rally has provided exciting opportunities for investors, but it's important to approach the market with balance. It could be smart to gradually invest over time and look at any market dips as chances to buy. Long-term future of the Indian market is looking bright. Remember, maintaining a diversified portfolio and keeping a long-term view are key to successfully navigating the market's ups and downs. If you found this video helpful, please make sure to give us a big fat thumbs up. It really helps us out. And if you haven't already, please hit the subscribe button and the bell icon below so you do not miss out on any future videos. Don't forget to drop a comment below with your thoughts, questions, or just to say hi. We always love hearing from you. And until next time, happy investing and stay tuned for more such insights on the Indian stock market.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to like this video and subscribe to the Wright YouTube channel. We will be back with many more insights, reviews, and market updates in the coming weeks. Till then, click on the bell icon to stay tuned for more such amazing Wright updates. Happy investing.